Let's look at a tax court case involving vehicle expenses because as a CPA firm we see a lot of problems with this deduction in our practice. Today we are going to talk about Mr. Woolpert's case. Mr. Woolpert was a consultant and he claimed on his 2016 personal tax return on a Schedule C form $7,528 in car and truck expenses. The IRS disallowed the entire amount and he had to pay not only the additional tax but also a lot of penalties and interest. So let's see what happened. We are going to start by seeing how you can claim your business car expenses. There are two methods that you can use to calculate how much you can deduct as a vehicle expense: the standard mileage rate and the actual expense method. The standard mileage rate is a fixed amount per business mile that you get as a deduction that covers the costs of operating your vehicle, such as gas, maintenance, depreciation and insurance. The actual expenses method allows you to deduct a portion of your actual costs of using your vehicle for business, such as gas, repairs, tires, registration fees and depreciation, based on how much you use your car for business. If you use your vehicle 100% for business, of course you are allowed to deduct 100% of these actual expenses. Now, it is very rare for a small business owner to have a vehicle used 100% for business, because a lot of times small business owners have one vehicle that they use both for business and for personal errands or for commute. But very important, regardless of which method you choose, the standard mileage rate or the actual expenses method, or if you use your vehicle 100% or not for business, you do need to keep a mileage logbook as well as corroborating documentary evidence to prove your business use. You are required to provide proof for the following information: the amount of each expense, the mileage for each business use of your vehicle, the total mileage for all use of the vehicle during the tax year, the date of each business use of the vehicle, and the purpose of each business use. If you fail to keep a mileage logbook, or if your logbook is incomplete or inaccurate, you will get in trouble with the IRS if you are audited, as we said happened with Mr. Woolpert. Keep in mind that vehicle expenses are on IRS's watch list. When you claim vehicle expenses, and depending on the amount you are claiming, your IRS audit score might increase. In addition, you should keep your mileage log on a contemporaneous basis. This means that you have to create the log at or near the time of each trip, rather than at a later date based on memory or estimates. And this is exactly what Mr. Woolpert didn't do. He used the standard mileage rate method to claim the $7,528 in car and truck expenses, and he did keep a mileage log, but his log was not contemporaneous. In addition, it was incomplete. His log made no mention whatsoever of the business purpose of each purported trip, nor the total mileage of all use of the vehicle, nor was he able to associate his business trips with his consulting projects. So the IRS disallowed the entire $7,528 in car and truck expenses he claimed. If you're interested in more details about this tax court case, I will include a link in the description of this video. But, as you can see, just keeping a mileage log without all the required elements, it's not enough to keep you out of trouble with the IRS. Our recommendation is to use a mileage app because this way it is really easy to maintain your log in a contemporaneous manner and to have all the required elements. And there are a lot of apps out there, some even free. If you use QuickBooks, QuickBooks has a mileage tracker that you can use. That's it for today. If you have any other subject that you're interested in and you'd like us to address, make sure to leave a comment to this video and subscribe to our channel because this helps with the algorithm and helps us bring more useful information to you. Thank you for watching.